What's up everybody? Nate here. So inflation is pretty much everywhere in the United States right now. From food costs to energy costs and even travel costs, just about everything costs more in 2022. This has left many Americans to feel hopeless and stuck about their financial future. Many of them feeling like they have to completely put it on hold because they have to keep so much money right now or else they might not have it in the future. In addition, many Americans can't even go out and do the things that they love and what they want right now because everything costs so much. I mentioned it before, but travel costs and energy costs in the United States have meant that many Americans are staying home. In 2020 and in 2021, some businesses did start to give out raises to their employees. However, this has not kept up with the inflation rate, which as of March of 2022 was around 8.5%. This means that prices have gone up by around 8.5% over the last year. Many other Americans have simply quit their jobs in search of a better one that's going to pay them more. With just about everybody trying to figure out right now if there is anything they can do in order to beat inflation. Well, according to investing legends Kevin O'Leary and Warren Buffett, there actually is a secret to beating inflation. So today, we're going to go over this big secret to inflation, and we're going to talk about the #1 mistake that Kevin O'Leary and Warren Buffett see that most Americans are making that keeps them just a bigger victim to inflation. But before I get into all of that, do me a quick favor and hit smash or destroy that thumbs up button below and ring that notification bell too. Both of those two things are completely free and they help to show me that you like this video and that you want to see even more just like it. Thank you so much for doing that. Now I want to start with Kevin O'Leary and the #1 mistake that he sees most Americans doing with their finances right now. Kevin O'Leary believes that most Americans are becoming a victim to inflation for one major reason. They are saving their money. Now you probably hear that and think, saving money? What would you rather me do? Go out and buy that Lambo or blow it on something I don't need? Well, saving money is super important, and my generation of millennials was basically taught this from birth. The #1 thing my parents told me in order to be successful was that you needed to save every dollar that you earn. I remember when I was about 16 years old, I got my first job. I worked at a little deli that was just around the corner to my house, and they hadn't gotten something called direct deposit just yet. That means every single time I got paid, I literally got a physical paper check or cash. Now, when I was 16, making that much money and getting that much cash was awesome. Sometimes I even literally went out and blew a lot of that paycheck. But as I continued to work and I worked at this job, I took a lot of that money and I basically saved it. It was pretty apparent for my parents at that point that I needed a bank account. So I remembered literally taking my paychecks to the bank and then depositing them into a savings account. Everything that I had went into a savings account, and eventually it went into a checking account that I could spend. At this point, I thought I was doing everything right, and if I didn't take a large portion of my paycheck and put it directly into the bank, I got pretty guilty. I thought I was doing something wrong with my money, like I wasn't being financially responsible. Now, I know for a fact that I am not the only one that felt this way. Many millennials that grew up in the same generation as me felt the exact same way. Their parents taught them that they needed to save every single dollar. So when Kevin O'Leary says that saving is a big mistake for many Americans, they have some words. Now, the reason that Kevin O'Leary believes that saving money is a big mistake when it comes to inflation is because of the definition of inflation. Inflation simply means that the monetary supply of a country is going up. This means that the United States government is printing a lot more money. As the United States government prints a lot more money, though, there is a lot more in circulation. More people have access to it, and when that many more people have access to dollars, they tend to go out and spend. This really isn't a problem until businesses start to run out of stuff, so they have to create more things in order to meet demand. That all unfortunately comes at a cost though, so as they produce more things, they have to pay more, and then they trickle those additional costs down to you. So prices rising is a byproduct of inflation. Now, it's important to mention that the United States government prints money every single year. Inflation is typically around 1 to 3%. However, over the last 6 months or so, it has doubled and even tripled that. As of March 2022, inflation hit an over 40-year high of around 8.5%. 85%. This means that if something costs $1 today, a year from now, it's going to cost around $1.08 or 9 cents. That's not really a huge jump when you're talking about $1, but if you multiply that by hundreds of dollars that you're spending every single month, well, now you have to pay a lot more. Now, inflation, when it's at a really low level, like 1 to 3%, isn't really a big problem for our economy. The Federal Reserve considers this as healthy because we need more money in order to grow our economy. As there's bigger demand in our economy, well, people now need to make a lot more money because we're producing more things. So they start to print. However, in 2020 and in 2021, the US government printed trillions of dollars all at once. And now it's estimated between around 80 to 85% of all of the dollars in circulation were printed over the last 2 years. This has meant that inflation is historically high, and businesses are not going to be able to give out raises that meet inflation. So that 2 to 3% raise, even if you got one last year or this year, you're still making a lot less money. That in itself is an entirely different conversation. However, many Americans are doing this twofold. They're not making enough at their jobs and they're saving money. Now, why exactly is saving money so bad? Well, Americans put their money in the bank and their money basically just sits there forever. All it's doing is sitting there in today's dollars. If I take $100 and put it in the bank right now, 10 years from now, I know that I can go to the bank and pull out that $100. So that money is pretty safe. However, all it's doing is sitting there, and inflation is going up every single year. Sure, right now inflation is historically high. Most likely it's going to come down over the next few years, but your money is still going to be losing value. The United States government is not going to stop printing money anytime soon. That's kind of what they do. So your money sitting in the bank is losing value every single day. Just like your dollars right now are losing value whether they're in the bank or not. You need a lot more money in order to buy all of the same things because prices go up. So in short, that $100 that you put in the bank today is not going to be worth $100 in today's money. It's actually going to be worth a lot less depending on whatever inflation is between now and the next decade. So what $100 buys you today might only be what $90 or $85 buys you 10 years from now. So you're actually losing a lot of money here. And $100 isn't a whole lot, but Americans are putting thousands and sometimes tens of thousands of dollars in the bank and hoping that one day they're going to be able to retire off of that. Or one day they're going to be able to use their savings for income or passive income down the road. Now this all goes back to what my generation of millennials was taught about money. We were told that we had to save every single dollar, and I started saving from when I was about 16. I didn't learn about investing or I didn't learn about passive income or any of this until I was way later in my 20s. And the only reason that we were taught about this is because our parents' generation was also taught this, and generations of the past were also taught this as well. And there is a big reason for that, and it didn't exactly start with banks. Many of our grandparents lived through the Great Depression, and just before the Great Depression or even during, there was a huge run on banks. The stock market was crashing and so was our economy, so Americans wanted their money back. And because of this time, Americans started to really learn the value of every single dollar. They didn't have a lot of money to begin with, so they had to save everything that they had, and things like the stock market and investing were not accessible to everyone during that time. So saving was important, and Americans literally started to stuff their money under mattresses or hide it under their bed. This became a huge problem for banks and the future of our economy, though, because banks need money in order to survive. We have something called a fractional reserve banking system in the United States. So when you take your money and put it into a savings account at the bank, well, the bank then takes that money and then lends it out. This is how they're able to give people money for loans and how they're able to invest to grow their business. And of course, if you want your money back, then you can go to the bank and get your money. But technically speaking, it's not the same money that you put into the bank. Well, banks couldn't survive with nobody putting their money into them, so they got really creative. They started to offer really high interest rates on your money for two reasons. One, the stock market was not accessible to everyday Americans, so there was no real way for Americans to grow their money other than through pensions. Remember, we also didn't have 401k plans during the 50s and 60s yet, so Americans were only saving their money, and they weren't doing it at a bank. And number two, banks banks needed people to start using them regularly so they could grow and they could start lending out a lot more money. Saving rates during the 70s, 80s, and 90s skyrocketed. We saw saving rates of almost 10% for certain banks. So yeah, it made a lot of sense for Americans to put their money in the bank. Basically, all you needed to do during this time was work and put your money in a savings account, and every single year, it's going to gain value. But this essentially stopped by the mid-2000s because most Americans were now starting to use banks again. They didn't really offer really high interest rates, and today, the average interest rate for a bank is only around 0.06%. So for every $100, you might earn 6 cents. Meanwhile, inflation goes up by 1 to 3%. So your money is losing around 2 to 3% of its value every single year that it sits in a traditional bank. So like I said, it didn't really make a lot of sense for banks to start offering really high interest rates by the mid-2000s. And as direct deposit really took over, Americans never even saw their paychecks. They got paid and their money immediately went into the bank. That's good for the bank, but it's bad for you. Now, don't get me wrong. I'm not saying that banks are completely bad here. Putting your money in a bank, especially when you're getting thousands of dollars worth of a paycheck, is a good thing. It keeps it protected, and having a savings account is good in certain circumstances. But now, what is the one thing that can beat inflation in 2022, according to Kevin O'Leary and Warren Buffett? Well, those two believe that consistently investing your money for the long term is going to greatly help you defeat inflation in 2022 and beyond. Basically, what they recommend is something called an index fund. An index fund essentially tracks a group of different assets on the New York Stock Exchange or a group of assets somewhere throughout the world. You essentially put your money in every single month and you're buying shares of that individual fund. This works very similarly with an ETF. You're putting your money towards a basket of different stocks. Now, the reason that Kevin O'Leary and Warren Buffett talk so highly about index funds and ETFs is because, for one, they offer instant diversification. Diversification protects your investments during the long term because you don't know how a particular market is going to react during certain economic times. Basically, if you invest in an ETF that has a ton of different assets in it from a ton of different industries, well, now if one of those assets goes down, you still have a bunch of other ones in order to protect you. This completely differs from individual investing, like buying a rental property or investing in an individual asset on the New York Stock Exchange. Sure, you can own a particular stock or bond, but if that's all you're putting your money into every single month, well, if that stock goes down, then your entire investment is on the hook. So they recommend that Americans buy into these funds, and nowadays it is easier than ever to do so. I mentioned it before, but in the 30s all the way through the 90s and early 2000s, it was really difficult for many Americans to invest. My parents never taught me about investing because it was really hard to do so. Nowadays, though, all you need to do is go on your phone and download an app, and you basically have access to the New York Stock Exchange just like any other investor. With investing now so accessible, you now have the option of thousands of different ETFs or individual stocks. And with digital banking in the 21st century, you don't even need to actually allot a specific amount of time in order to make these investments. You can set up auto deposits with you, your bank, and the brokerage that you want to work with every single month. This makes the investment completely passive, so all you have to do is work and your paycheck automatically gets divided into different investments. And I know what you're probably thinking when it comes to investing. Well, if I put my money in a stock or an ETF or buy real estate, there is never a guarantee that I'm going to see a return from that money. In fact, I could lose everything. And this is definitely a risk when it comes to investing, but there is a big problem with this logic. When you invest your money, you are never guaranteed to get anything out of it. Like I said, you could end up losing everything. But the chance and the opportunity is there for you to grow your money. Right now, the New York Stock Exchange is extremely volatile. If you invest your money in the short term, you might not see really high gains from that. Over time, though, the New York Stock Exchange and other investments have always gone back up. Every single time they've even gone into a crash, they've always returned to new record highs. Will that continue in the future? Well, nobody really knows. Historically, we've been through a lot. So if that is any indication, then we can say with good certainty certainty that our stocks and our market is going to continue to go back up. So investing in them, while risky, is better for the long term than in the short term. However, I know if I take $100 and put it into a savings account right now, 10 years from now, 20 years from now, I'm still just going to have $100. Sure, I might have a few dollars more because banks do offer a small interest rate on my money, but for the most part, I'm going to have the exact same amount that I started with, and that money isn't going to take me as far. I know that. I know for a fact that that is what's going to happen. So while it seems a lot less risky in that sense, it's actually way more risky because I know that my money is going to lose value. If I put my money into an ETF, chances are eventually it's going to grow in value and it's going to make me a lot more money than inflation. So there are risks to everything in life and there's consequences for that. You have to decide what makes the most sense for you and what your financial goals are. If your goal is to try to beat inflation, then the only way to do that is to invest your money. That's the secret. Investing consistently for the long term. And like I said, saving definitely has its place. I don't want to say that you shouldn't save your money at all. If you have nothing in your savings account right now, then yeah, you need to save your money because you are one disaster or financial emergency away from losing everything. If your car breaks down or you need a new AC at your house, then you're gonna have to have cash right now in order to buy that. If you don't have anything in your savings, then even if you are investing your money, you're gonna have to pull a lot of that money out in order to pay for that expense, and you're gonna pay taxes on that money. And you're gonna be dipping into your future funds, which you definitely don't wanna do for a problem of today. So you definitely need to save your money. I recommend starting with around $2,000 or maybe $3,000. This is going to cover you for most financial disasters of life today, like if you get a flat tire or if your car breaks down. About $3,000 is going to protect you well enough. That is called a short-term savings fund. Beyond that though, you need a long-term savings fund. This is going to protect you against all of your expenses over a specified period of time. So to calculate this, add up all of your monthly expenses that you pay every single month. These are going to be all of your obligations, any loans, credit card debt, and energy costs that you have every month. Once you figure that out, start saving. So if you have $1,000 in expenses every single month and you want to protect yourself for 6 months, you need around $6,000. Obviously, this is going to depend on how much risk you want to take on. Some people only want a 3-month savings fund. Some people want a 12-month plus savings fund. It really just depends on your risk tolerance at that point. After you've saved that much money though, all of the rest of your money is going to go towards spending and investing. So at that point, you're using your savings effectively by only protecting yourself for a certain period of time, and you're limiting your risk because only that amount of money is going to lose value. Then you're upping your game by putting the rest of it into an investing account that starts to beat inflation over time. This is going to lead you to a lot of other avenues like building wealth in the future, but we'll save that for another video. But now I want to hear from you on this issue. What do you think about Kevin O'Leary and Warren Buffett's method to beat inflation in 2022? Do you think that the secret of investing still works in today's economy, or is there a better way in order to beat inflation? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all of the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.